welcome back to another episode of The Daily Budget, your favorite finance podcast brought to you by yours truly, Alex and
Marco.
Here we go. And today we have a good one.
Super good. Actually, super important. I think a lot of people have asked us in regards to this topic.
Mm-hmm. And it's something that you use every day. You may not think about it. You may not be aware of it, but
it's there.
It's there. It's a big part of all of our lives, and knowing how to use it, how to use it responsibly.
Yeah.
And how to make it work for you is key to helping you live a happy life financially.
Wait, so we're talking about money?
We are talking, of course, about credit. Yes. So, credit. What is credit? It's one of those words that you say and everyone says, yes. Oh yeah, credit. But what is the definition of credit as seen by banks, investment professionals, the financial industry as a whole?
Yeah. Well,
credit is, please go ahead.
The ability for a customer or to obtain a good or service before payment is made, and that's really based on a trust factor. And that trust factor is determined by your credit score.
Yes.
Now, what's your credit score? How's it calculated?
So, a credit score is a number that in essence indicates your trustworthiness, or your creditworthiness is a better way to put it.
Yeah.
And so the way a credit score works, how it's calculated, it's a number typically it's between 300 and 850 based on the FICO score, which is the most common method of using a credit score. You'll have it, FICO scores are reported by the two main credit bureaus, TransUnion and Equifax. And this one number has such a big impact on your life, and many people are completely unaware of just how important it is to have a good credit score.
Yeah. So
how's it calculated? Well, nobody knows. we say that jokingly, but it's true that credit scores are calculated based on like a proprietary algorithms and formulas that are very kind of closely guarded secrets by the credit bureaus and FICO. But we do know, and in general, credit scores are calculated based on several broad factors. So the amount of credit that you have, the amount that you owe, payment history, so making payments on time, making adequate payments or full payments, minimum payments depending on the situation.
That's right.
It's based on the length of time you've had credit accounts. So someone who's had, let's say, two people, one person who's had a credit card for a year and one person who's had a credit card for 3 years. The person with the one credit card or the credit card for 1 year will have a much lower score than someone with 3 years because they haven't built up that history.
Yeah.
And it's also based on the number of revolving credit accounts you have.
Yeah.
Also called the number of trades, I believe, if I remember correctly from our banking days.
Trade line. Yeah.
Yeah, and so those include things like your mobile phone plans, mortgages, student loans, auto loans, all of that.
Yeah. Anything that requires basically your SIN number is going to be reported over to your credit.
Yeah.
In a goods and service space, of course.
Mm-hmm. So what's a good score? We mentioned a minute ago that scores range between 300 and 850. And as one might expect, a higher number is a better number. But where's that cutoff point?
Where's the threshold?
Where's the threshold? Where are you in good standing? Where are you in okay standing? And where are the alarm bells starting to ring?
There's actually thresholds. So anything between 300 and 650 is considered subprime. So you're a very risky lender. You're somebody that potentially has had issues in the past where non-payments or even collections and whatnot. And then there's also the second range, which is between 650 and 750 or 749.
Yeah, I mean, different people will say different things, but the general rule of thumb is between 650 and 750-ish is considered good. And that's where you'll find, I would say, the majority of people, the majority of people who have a few accounts, who make their payments on time.
Yeah.
Maybe they miss a payment once in a while.
Yeah.
It doesn't mean you're perfect, but it doesn't mean that you're irresponsible.
Yeah.
And so that's where, that's the bandwidth where you'll find the majority of people. And again, it's good, right? Those are the people who will have just the normal interest rates. Right. They won't be penalized, but they won't see any benefits on the other hand. And then from 750 to 850, that's where you get into what's considered excellent. And those people may actually enjoy discounts on interest rates. And this is why credit score is so important. Because not only do you get the perks like, for example, paying a slightly lower interest rates because you're more trustworthy or a lower risk to lenders. But it can also mean you're able to get credit in the first place.
Yeah, and higher credit too.
Yeah, higher limits.
And we also spoke in a few podcasts ago, we spoke about your GDS and TDS, so your ability to actually pay back your debts. With a higher credit score, they may actually stretch that GDS and TDS a little bit further than if you had a lower credit score.
Absolutely. There's a little more wiggle room there because you're a customer in good standing and they trust that you will repay it, even if you may be taking on a little bit more of a debt burden than what the recommended guidelines stipulate. On the other hand, you'll have the subprime borrowers, which Marco mentioned a minute ago.
Yeah.
And if you have a poor credit score, it can quickly turn into a vicious cycle where you have to pay higher interest rates.
Yeah, you get penalized for mismanaging your credit, and that's it could take a toll, and it's very significant, especially when you're looking for further and long-term debts, such as a mortgage.
Yeah, and it makes it that much harder to kind of climb out of that hole too. Yeah. The system really doesn't do subprime borrowers many favors. The good news is there are ways you can improve your credit score, and we're gonna talk about those in a few minutes here.
Yeah.
And
before we actually get there, should I talk about my story? Actually, wait. You know what? There's actually something very important. Now, let's not get it twisted. There's your credit, which is the overall trust factor that you have, and there's also something called a credit card.
Mm-hmm. So these are credit products versus credit as a concept.
Yeah.
Now, credit as a concept we defined at the very beginning of this episode, right? Ability to obtain goods or services before payment is actually made.
Yeah.
It's essentially, credit is an IOU. That's all it is.
Yes.
And credit products, that's where we get into the ubiquitous credit card. You have charge cards and then loans. Loans, lines of credit, your mortgage, your car loan, your line of credit,
even your phone plan.
Yeah, these are all credit products. And so it's important to think of the distinction, and we'll talk a little more about them in just a minute.
That's
here.
Right.
Some do's and don'ts, but yeah, Marco, you mentioned a minute ago you have quite the story. And,
yes, I have quite
the story that inspired this podcast. Actually, we were going to make this, but we decided to rearrange the order of episodes and record this one while it's still fresh in your mind. So please,
go ahead,
take the floor.
I'm a big, I guess I used to be a big believer in you can have credit without necessarily having a credit card. And you could also have a great credit without necessarily having a credit card, because there are also other credit methods which report better into your credit score than a credit card would. So for me, credit cards, no. And that kind of back over last week. So I took a trip with my friends over to Toronto, and this was amazing. We had a great time. But of course, as per every trip, there comes an ending where everybody's got to go home. Now, I took the Via Rail to get there, so of course it was there and back. And on my way back, they canceled my train. Okay, not bad, right? The next train that was coming wasn't going to be for another 8 hours later, and I didn't want to sit just in the train station or just sitting in Toronto. At that time, our hotel is we're already checked out of our hotel, so we can't really go back. I've got bags. I don't want to be traveling around Toronto with bags and whatnot. So what do I decide to do? I decide, okay, well, what's my next best option? Let's see. I wanted to I actually took my way. I went over to Montreal, and this is where things got worst. So as I go to Montreal, I'm looking around for options as to get myself home, ride shares and whatnot. Ride shares cancels on me. No buses, because you can't actually have Greyhounds in the same day that you book it, or even like Kango ride for other ride shares and whatnot. So you can't take it the same day that you book it. And so I kind of get stuck in Montreal around 8 o'clock at night. I'm thinking, well, I could either sleep in Montreal, or just basically just get a rental vehicle to get home. Now, the one thing that is very hard in this world is to get any types of good and service prior to your payment if you don't have a credit option or a trade line. Therefore, I don't have a credit card, so I really couldn't rent a car to get home, even though it's only $60. I could pay that in cash. No, they require you to have a credit so that they could hold a deposit or whatnot if any liability was to occur on the car. Same thing as a hotel room, they actually require you to have a credit card in order to actually put the deposit on the credit card and a hold in regards to if any damages was to occur. So I quickly learned that even though I do have credit and I do have a credit score, I was limited as to what I can do just because I was missing a credit card. So more of the story is credit is great, but having a credit card might actually be important as well, because that specific credit card can help you get out of a lot of situations where they don't accept immediate payment. They actually want you to hold on to it until the goods and service is fully completed.
Yeah. So, Mark, your credit card is texting me, asking me for money.
Yeah, that's exactly what it was.
I turned into a sugar daddy for that trip, trying to get him back home.
Yeah, that trip turned out to be very expensive, and I'm actually very grateful to have friends like Alex who were able to help me out in those ends, because.
Mm-hmm. But yeah, and it's a really, we're laughing here and now, but it's a really, first of all, it's a stressful experience, and second of all, it underscores the importance of maintaining a good credit score, because if you don't have a good credit score, you're not even going to be able to get a credit card in the first place. Or if you do, typically borrowers with subprime credit scores, they can access secured credit cards, which are credit cards with a
pre-deposit,
basically a pre-deposit, exactly, that you kind of borrow against.
Yeah.
And the terms of those are really they're not good. Yeah. But not being able to get a credit card really handicaps you. That's
right. And I've learned my lesson. I've gone and applied for a credit card, and it's on the way.
Mm-hmm. Yeah. And it's funny you mentioned that, because here we are. We're a finance podcast. We're a financial literacy initiative. And then you just said you don't have a credit card.
That's right.
Right? So why is it that you don't have a credit card, and we're doing a financial literacy podcast?
For myself, not that I don't believe in credit cards. I believe in paying it immediately when you can. I did have a credit card back in the past, and of course, being young, being less vigilant than I am now, I did have a little bit of fun, and I learned my lesson that I had to close this credit card, because having money ahead instead of just paying in cash was a little risky for me. But as well as it also highlights the fact that I also want to highlight the fact that you don't need specifically credit card in order to build your credit. Certain things such as a line of credit, a personal loan, even your cell phone plan or your hydro at home, these are all things that report under your credit. These are all things that actually help you build a trust with lenders and build a trust with these lenders in regards to goods and services that are prepaid. Your hydro goes throughout the whole month before they actually charge you for it. And having a good credit can actually help out. You can't have, in Canada you can, but you can't have a credit card without, you can't have a cell phone without a credit card. And just like your cell phone plan, you use your cell phone the whole month prior to you paying the bill.
Yeah. No, exactly. But a credit card is the one thing that pretty much everybody has, and that can be, your primary driver.
Yes,
and method of kind of building and maintaining your credit score.
And that's where I learned my lesson. Where although my credit is rebuilding or it's great or whatever the case may be, is if I'm unable to have a credit product that has an immediate usage, there's a lot in this life that I'm going to miss out on, such as a rental car to get my butt home.
Yeah. And this, I think, segues a little nicely into some of the do's and the don'ts of credit. Okay, so you touched on a couple things that I'd like to talk about. So you were talking about essentially like knowing the terms of your credit cards or credit products. Things like the interest rates, the payment dates, pay periods, any kind of penalties, any kind of leeway. So knowing exactly what it is
your annual fees
that you're getting yourself into can save you a lot of headaches down the road.
For sure.
If it's something that, let's say, you can go 30 days. So basically something that you miss a payment, you have the 30 days until the next payment, essentially, to make it. Otherwise,
that's when you will start reporting.
Yeah, and then there are some products like charge cards, like Amex cards, where you have to pay the full balance off every month.
Yeah.
Knowing the differences and the distinctions, reading your contracts, reading your terms and conditions. Nobody does it. Everybody should. At the very least, when it comes to finance.
Yes.
Financial products in particular. Another thing to know, I believe it to be common sense, and if you've been listening to the podcast up until now, I think I don't think this will come as a surprise. Know your credit score.
Yes.
Okay, so how do you find out your credit score?
Well, we live in a very advanced technology age where you could actually get it directly from Equifax and TransUnion directly, or you could use something like Credit Karma. Nowadays, in Canada, your banks actually have access. You could actually look at your Credit Karma, your TransUnion credit score through your bank. I know Scotiabank has it. RBC has it.
TD and BMO have it as well.
TD and BMO have it as well.
One thing to note is that, and it states right in the app as a disclaimer,
that
score isn't as accurate as getting the report directly from Equifax or TransUnion. The advantage is it's free.
Yeah.
Right, and if you actually go and get the report directly from the companies, you're going to be paying a fee. It's not too big. I want to say $20. I'd have to double check.
Because you get access to one free credit report, which basically states who has a say within your credit. Now, to see your credit score specifically, that's where you will actually have to pay a service for specific when you're going directly with Equifax or TransUnion.
Yeah, and this leads nicely into another do. Do read your credit bureau.
Yes.
Because that will detail all your accounts, and it's entirely possible that you may see something on there that was either misreported, something that that's there in error.
Yeah.
Because, for example, I had before I got my current cell phone plan, I was with another provider, and when I switched over, I closed that account. However, it turns out there was a small balance outstanding that I wasn't aware of.
Sent it to collection, didn't they?
They didn't send it to collection. No, actually, I got an email. I got a communication from the company asking to close it out, which I was thankful for.
Yeah.
But yeah, I had that mark on my credit bureau as kind of a delinquent account.
Yeah.
And so, if I checked my credit score, thankfully, that raised the red flag, and around the same time, the company reached out to me, and so I was able to settle and get everything closed out. But it just goes to show how, even if you think you did something right, human error or a mix-up in communication on the other end
could have an impact.
Absolutely.
And that's why it's important, very important, to actually look into it. Look into your credit at least minimum once a year.
I would say more than that.
Twice. Twice.
If you're in good standing, maybe once a year. If your credit score is kind of okay,
if you're
twice
building
a year,
if you're building your credit score,
once a month.
Once a month, because these your app actually refreshes. If you're getting through your bank, they refresh every month. So once a month, check it out. See how you actually see what methods and strategies within your personal life is either helping or not helping your credit score.
Yeah, and remember to be patient, because it's really easy to have your credit score drop. It takes much longer to build it back up. It's like, well, it's trust. That's all it is, right? So easy to lose trust, hard to build it back up again. So you need to be patient, you need to be consistent, and you need to be dedicated. So
now,
some don'ts.
Let me take over this part.
Yeah, all you.
So the first one is, of course, don't think of it as free money. This is not free money. It's better for you to even think about it as an emergency money than as free money, because well, you're going to have to pay it back.
Yes.
And not just pay it back. There's going to be more likely interest involved in there. Mm-hmm. So you're going to pay more than your initial takeout.
Yeah, and that's the trade-off, right? In exchange for letting you access that good service in advance, the lender is going to ask for some additional compensation on the back end.
That's right.
And how much that ends up being is entirely dependent on how you repay it.
Mm-hmm.
There are some people who treat credit cards as just higher limit debit cards. And charge cards are kind of an example of that, because I like to use my Amex.
Yeah.
I'll put purchases on it and then I pay it off in full.
Yeah.
Right? I get the advantage of the points and the rewards that come with the card. But I also don't invoke interest charges by carrying a balance from month to month.
That's right.
And that segues into our second point, which is don't make only the minimum payments.
Yeah.
The minimum payments are designed to benefit one person, and that's the lender. It's not you. If you only make the minimum payments, depending on the interest rate, and students, especially Americans with student loan debt, will know what I'm saying here. You can actually keep making the minimum payments, but have your outstanding balance grow.
Increase. Yeah, and that's very dangerous.
Yes.
Because you're thinking you're making progress, but you're just taking a step back. One step forward, one step back.
That's exactly
literally what it is.
That's exactly it. And so if you have, especially a larger credit balance, like a student loan or a car loan, run the numbers. See what your minimum payment is. See what your repayment schedule will be. How long it'll take you more or less to repay it. And then break it down how much will be the principal, so like the amount of the loan, and how much of that will be interest.
Yeah.
And there's a point where the interest rate, it'll add more interest than your minimum payment will take away.
Yeah.
And you want to avoid getting to that point at all costs.
Yes, that's technically over leveraging yourself, because as opposed to taking 2 steps forward, it's 1 step forward and 2 steps back. And now there's, again, another don't is don't have too many credit lines or credit cards or credit lines open or balance used within this credit lines.
Yeah.
Don't max out your credit cards and your loans. And as well as, if you're going to purchase something, please don't buy something you can't afford.
Yeah.
That's just going down the rabbit hole.
Yes. Another thing, don't apply for too many lines of credit or credit product within a short time span, because
that's a negative impact.
Yeah, there are what's called credit pulls. Soft and hard. Hard pulls, they both access your credit score and the credit information, but a hard pull, which is something done when you're, for example, applying for a mortgage or a credit card, that actually impacts your credit score and it'll knock you down a few points.
Yeah.
And so if you've ever applied for a credit card or gotten a mortgage and checked and saw that your credit score has dropped afterwards, that's why. It's nothing to be alarmed about. It's just natural, but you need to be aware of it.
Now,
a soft pull
does not touch you.
They say it doesn't. It may impact your credit score by a few points, not a lot. A few. But when you think about it, if you have someone who's going, especially someone with a low credit score, they apply for one credit card, they get rejected. That credit pull is still reflected on their bureau and it's dropped their score. Yeah. And now you imagine that person, they're desperate for a credit card. They go and they apply for another one and another one and another one. and it's just knocking them down each and every time.
The desperation factor. Your credit bureau is going to look at your history and say, hey, this person is really trying to over leverage themselves over and over and over again.
They're desperate. And they've been denied by all these other people because that information appears. When I was in my banking days, I would have people come in and try and open accounts. I would run their credit bureau, and I would see that within the last week and a half, they had went to 2 or 3 other banks and tried to get accounts, and they were all summarily denied. Right? Which is a big red flag.
Indeed. Indeed.
Another one. Don't make late payments. Don't miss a payment.
Not.
Yeah.
There's
little asterisk there.
That's right.
If you miss a payment, obviously you want to pay that as quickly as possible, which would be a late payment. But always make your payments on time.
You have, usually it's around 24 days or 24 days to 30 days of, what's it called?
Grace period?
Grace period, that's the word. Where you can make a payment to your credit without it even affecting, or even the interest being kicking in. So you have around 24-day grace period or 27-day grace period where you can make the payment for whatever goods or service you used or the credit or amount you used on your credit card without them actually charging interest.
Yeah, but don't get sloppy. Don't rely on that. Make the payment on the day of. If you don't think you're going to be able to make the payment on the day of, well, then you shouldn't have bought whatever it was in the first place. Which goes back to what you were saying earlier about buying something, that you can't afford.
Yes.
And as a rule of thumb, personally, I don't use my credit card to buy anything that I don't have the money for my bank account now.
Yeah.
I may choose to use a credit card because I don't want to spend all that money at once. I may want to invest it in something, or I may want to put another purchase on the card, and I don't want to have all those funds tied up. But I don't put anything on credit that I wouldn't be able to pay off right away if something went wrong and I needed to get rid of it.
Now, we got a few questions that we're going to transition into, because now we've loaded you guys with information in regards to credit, and you're probably wondering, okay, so if I have a credit score, how do I improve it?
Yeah, there are a lot of questions we get, and we see people ask all the time, right? Like you just said, my credit score is bad, how can I improve it? Make your payments on time. Don't max out your cards. Don't carry large balances.
Do not. Nothing over, I personally would say don't carry any balances over 30%. I would say that, but they usually say don't carry your balance over 60 to 70%.
Yeah, it depends a little bit on your limit too, because your utilization percentage, if you have a card that has a higher limit, but you don't usually spend, your utilization is going to be a lot lower, and that's not necessarily, a bad thing.
And that actually gets reported on your credit bureau because they see, hey, look, he has a large balance, but he's only using this amount. That means we can trust him. He's not going to take everything out. As opposed to somebody who does take everything out, they're looking at him, hey, look, this person is a little bit more risky because whenever credit is applied, credit is used immediately.
Yeah. The higher the limit, the more of a red flag that is.
Yeah.
If you find that you're somebody who, let's say maybe has a little bit of a problem controlling your spending, maybe you're a very impulsive spender or compulsive spender, you can get a credit card with a very low limit, so you cannot spend that much. And in a case like that, if you have one with a low limit, $500,000, you're not going to be worried about the utilization percentage because it'll obviously be a lot more than someone with a $5,000.
Yeah.
But that's a good way to kind of help manage your spending and keep it manageable, small payments, but pay it off. Pay it off on time, early if you can, even better. And tying into the other factors other credit score factors we mentioned. Don't have too many products, what's called revolving accounts.
Don't go applying, if you're building your credit, don't go applying for credit. As we mentioned, applying for credit does reduce your score, and especially if you are rejected, then it leaves a bigger impact on your credit score. So if you do have that, do not go apply. If you are building your credit back up, do not go apply for them. Wait until you are self-sustainable, where you may not feel like you're in as much debt. Now, another one too is if you want to build your credit, speak to a professional. Speak to a credit professional.
Yes.
There are a lot of people out there that actually are there to help you build your credit without actually going through bankruptcy or anything like that. They're actually there to look at your finances and help you determine what may be best.
Debt consolidation is an option that's used by many people. That
weigh out your
really
options.
Help.
Yes. Weigh out your options.
Yeah. But in a worst case, bankruptcy may be the best way out. It's never a first choice.
Never.
And neither you or I are bankruptcy professionals. Long-term impacts, because it stays on your credit bureau for 7 years. It destroys your credit score. You go to nothing.
Nothing. Basically nothing.
And you have to start from nothing, and it can be incredibly difficult.
Yeah.
It's something that would really only be used as a very last resort, where nothing you can do in your current situation will help you climb out of debt.
Yeah.
So it's not an option to be taken lightly, and that's why it's all the more important to speak to a credit professional if you're in financial distress.
That's right. Now, as important as credit sound, is it possible at this point to go through life without using credit?
Possible, but very difficult, at least in our society as we know it today. Because if you went through life without using credit, it means that you have to pay cash for pretty much everything. Now you can imagine, even buying, let's say, a new laptop or phone with cash, can be pretty difficult for a lot of people. Now try and think of buying a new car in cash, buying a house in cash, paying your tuition in cash. And you quickly see why credit has become so popular, and why, when used responsibly, it can really help somebody out, because it's used to access a good and service that you cannot otherwise afford at the moment. But by agreeing and entering into a contract to repay it over time, suddenly said good or service becomes much more affordable.
Yeah, affordable.
Absolutely. Dave Ramsey, a very prominent finance, personal finance guru, YouTuber, podcaster, is famously or infamously, depending on your perspective, a big proponent of avoiding credit at all costs, which can be a wise course of action if you're someone who's recovering from a bankruptcy or large debts, and you're trying to make sure that you stay the course.
Yeah.
But credit really is a necessity in today's world. And even having a small amount can help you a lot if you have no or bad credit.
The importance is we live in a society that has immediate needs, even though they have a very, very long-term effect, right? If you need a house, you need shelter immediately.
Yeah.
But in order to actually be able to afford a home, it's going to take you years. That's why credit comes in immediately. Gives you the ability to safely and securely have ownership of property, assets.
Absolutely. So, I think the moral of the story is credit bad? No. Not if used responsibly.
That's right.
Right? As with everything, it in itself is neither good nor bad. It's how it's used and how it's viewed that lends it that perspective.
Yes,
exactly.
And of course, if I have bad credit, I'm going to be mad about my credit.
Absolutely.
And if I do have more or better credit, I'll be more humble about my credit.
Yeah.
Right.
Yeah. And so, do you have anything else?
Ironic how it's a direct reflection as to how you use your finances. How you go about using your finances is directly related to your credit.
Absolutely.
Right? That's
it's the circle of life.
Yeah. It's like, as important as liquid cash is in our society, credit has probably surpassed that.
Credit is king.
Credit.
All hail Visa.
All hail MasterCard. Amex.
That's how we end our prayers. Amex.
Amex. That's it for us today.
That's it for us. We hope you enjoyed. We hope you learned. Please let us know on social media if there's anything else that you want us to talk about, any questions you have, any topics. Make sure to give this video a like, subscribe to our channel, follow us on our socials, and we will see you in the next one.
Yes, next time I'll have a credit card.
There we go. That's it for us. Amex.